welcome back to the channel, guys. So this is going to be a special video about how central banks all over the world impact our trading in the forex markets. So without wasting any time, let's jump straight right into it, guys. So how do banks impact forex trading markets? So this is going to be the general trading, all markets, the New York market, London market, the Asian market, the Aussies, and everyone. So this is going to be general for all. So we have three major ways we've analyzed properly how all these central banks impact the forex markets. So, and these are going to be interest rates, their monetary policies they always issue month in, month out, and all the economic data releases. So let's try to look into this in details. Let's go, guys. So let's first look at the interest rates. So all the central banks, so that will be the Reserve Bank of New Zealand, Reserve Bank of Australia, the Bank of England, the Reserve Bank of Chicago for the US markets. So all those are the major, those are some of the major central banks all over the world. We are choosing these ones because this is where the major markets are located, that like the London Stock Exchange, the New York Stock Exchange, and the other ones. So how do these interest rates impact our market? So most of the banks, they will try to increase or decrease the rates of their banks, like how the Aussies did this exact month exactly. They try to either decrease the interest rates right there when they had a lot of inflation on their currencies, and this will always try to help them sell off their currencies if they see a lot of inflation. And if they increase those interest rates, they most times try to attract foreign capital, so they are looking at increasing the liquidity in their local currencies. And the second thing, always the monetary policies. These are some of the procedures they always use to control liquidity in the markets. So for example, they use some expansive policies that will always increase the money supply, which will lead to the devaluation of the currencies. And this is always done when they see that the economy is tightening. They try to do expansive policies where they lower the interest rates, people will continue borrowing, and all this will lead to the weakening of the currencies, the local currencies, which will end up pushing the markets to the upside, but the currency will be getting devalued again and again. So where do we see this in the markets? We always see the Federal Open Markets Committee for the US markets. They will always issue data release where they will decrease the interest rates, and you will see a lot of a bull run in all the other currencies that are trading against the US dollar. And we saw also this recently right there when they decreased the interest rates on the Australian dollar, and we saw a huge run against all the other currencies, which were GBP AUD and Euro AUD and AUD Canadian. We saw some pretty big runs right there, as you can see. Also, if you look out on let's try to see at GBP AUD. If you look at GBP AUD, you can see that huge run right there. This was caused by the decrease of interest rates on the Aussie dollar, and you can see how that impacted the whole trajectory of AUD. So it affected also GBP AUD, and it created a very big bull run to the upward side the entire week and the previous weeks before, even the last week in July. So you can see how interest rates always move the markets at a very, very high and volatile pace. So those monetary policies, you have to account for them in the long run. Because so if you see such a monetary policy on any currency like the GBP, the USD, just expect a very big trend in the market in the coming weeks. So you have to understand how all this comes together. So they increase the interest rates, and this will lead to a currency creating a very, very big run or a big trend. So those monetary policies are very, very, very crucial. And on the other side, they will always use contractionary policies to reduce the money supply, and potentially this will lead to currency appreciation. So this has been the move they have been doing with the US dollar on the almost at the end of the last year till around February. It was still around February or March. They were increasing and increasing the interest rates again and again throughout almost the entire year. This tried to push the currency to a very, very high appreciation, but the inflation was also rising through the roof. So all these monetary policies come together and they will always impact the market. So higher interest rates, higher inflation, higher the FOMC data releases, all this comes together and they always impact the market. So how do we position ourselves with all these bank policies? So you have to always factor in only the huge bank policies, like how they handle inflation, which will be the consumer price index, which will be CPI, and how they handle PPI, which is the producer price index. So CPI will always monitor inflation, and PPI will monitor the price at which the producers will always the price for goods at which the producers put in the market when they are bringing goods into the local markets. So those two are always key points where the central banks will issue new monetary policies. So any policy, any economic data you see, you always expect new policies coming on the interest rates depending on how those inflations are or how the producer price index is in the previous month. So the third and last way these central banks impact the forex market will always be the economic data releases. So here we are always looking at the major economic data releases. And which one are those? They are always the growth. If you look at, let me highlight them for you right here. They are always growth, news about growth, inflation, employment, and exactly central banks. So if you remove the medium impact and you leave only the high impact, and you try to remove every currency, for example, and leave USD only, this is the forexfactory.com site. You will see they will show you core retail sales. So this will fall in the growth of the economy. FOMC meeting, which will fall in the central banks, and unemployment claims, which will fall in the employment data release. So those three. So the one missing is inflation, and this will be the consumer price index. So those are the major economic data releases that will always impact the market, and basing on this, the central banks will determine the interest rates on the coming meetings, and the interest rates will always determine where the entire market will move. So always look for growth economic data release, which is retail sales, automotive sales, and then look at inflation data release, which is a consumer price index and producer price index, and then look at the employment data release, which is the non-farm payroll and the unemployment claims, which is weekly throughout the entire month on the USD currency. And then the lastly will be looking at the central bank's decision, which is the federal funds rate for USD and the cash rate for AUD and New Zealand USD. So that is how you look at the bank's decision and all the other economic data release and put them together to make a clear and informed decision of where the market is going in the long run. So this helps you as a trader to understand the market in depth so that you don't lose out on those big moves. I hope this video can give you a clear understanding of how to go about the fundamental side of the forex market, because this is really very important as the technical analysis of the market. I know some of you guys this may sound complicated, but you always go to forexfactory.com, try to check all the boxes on the news and try to check in all the currencies you want to see news about. Pick the high impact and medium impact right there, apply the filter, and try to look at all the news that are coming out throughout the week. So like CPI on Canadian, so this is trying to show you the inflation rate on the Canadian pair, and this will determine the future interest rates of the bank. From the inflation, they will determine the interest rates. For example, right there, inflation going high, they will try to implement new interest rates. So thanks guys for watching, and keep it up. If you haven't subscribed, subscribe and hit the notification bell. Thanks for watching.